For nearly a century, the data was settled. From 1927 to 2020, value stocks, cheap, boring, unloved companies, delivered a significant and consistent return advantage over their faster-growing, more glamorous counterparts. It was the foundational truth of investing. And then, the last decade happened. A handful of world-changing technology titans rewrote the rules, delivering returns that made the old value playbook look obsolete. This has ignited the single greatest debate in modern finance. Is value investing dead, or is growth investing a bubble waiting to pop? This is not a simple debate. It is a clash of philosophies. In the next 10 minutes, you will learn the core principles of both value and growth investing, understand the specific economic environments where each strategy thrives, and discover how the world's most sophisticated investors have moved beyond this false dichotomy to build a superior, unified framework. To understand this debate, you must understand that value and growth are two fundamentally different ways of seeing the world. Value investing is the philosophy of Benjamin Graham and a young Warren Buffett. It is the art of buying a business for significantly less than its intrinsic, underlying worth. The value investor is a financial detective, poring over balance sheets to find hidden assets and stable, predictable earnings that the market is foolishly ignoring. Their core question is, what is this business worth today? They demand a margin of safety, a discount between the price they pay and the value they get. Their key metrics are often a low price-to-earnings, PE ratio, or a low price-to-book, PB ratio. Growth investing, on the other hand, is the philosophy of investors like Philip Fisher and Peter Lynch. It is the art of identifying companies that are poised to grow their sales and earnings at a rate far exceeding the rest of the market. The growth investor is a visionary, focused on innovation, competitive advantages, and massive addressable markets. Their core question is, what will this business be worth in 5 or 10 years? They are willing to pay a premium price today for what they believe will be a much larger and more dominant company tomorrow. So we have two opposing tribes, the bargain-hunting realists and the forward-looking optimists. But how do these philosophies translate into real-world portfolios, and what is the crucial economic factor that determines which tribe is winning at any given moment? The cyclical battle between value and growth is not random. Its performance is deeply tied to the macroeconomic environment, specifically the behavior of interest rates and economic growth. Theory: the economic levers. Growth stocks thrive in low-growth, low-rate environments. When the overall economy is sluggish, the market becomes starved for growth. Investors will pay an enormous premium for the few companies that can generate their own spectacular growth, regardless of the broader economy. Furthermore, low interest rates make a company's distant future earnings more valuable when discounted back to today. The period from 2010 to 2021 was a perfect storm for growth investing. Value stocks thrive in high-growth, rising-rate environments. Value stocks are often more mature, cyclical businesses, banks, industrial companies, energy producers. These companies are the engines of the real economy, and they do exceptionally well when the entire economy is firing on all cylinders. Rising interest rates also tend to hurt the high valuations of growth stocks more, making the relative appeal of cheaper value stocks much greater. Analogy: the tree farmer's dilemma. Imagine you are a farmer who invests in trees. A value investor is a lumberjack who analyzes a mature, fully grown forest. They calculate the current market value of all the timber. If they can buy the entire forest for 70 cents on the dollar, they do it. Their profit is a function of buying a known quantity at a discount. It is a game of present value. A growth investor is a botanist who buys a plot of land and plants a dozen unique, genetically engineered saplings. They know most may not survive, but they believe one or two contain the genetic code to grow into the largest, most valuable trees the world has ever seen. They are not focused on the timber value of the saplings today. They are betting everything on their future potential. Example, a tale of two companies. Value. Think of a company like Procter& Gamble. It's a mature, stable business with predictable cash flows and a healthy dividend. It isn't going to grow at 50% a year, but it's a known quantity. A value investor buys it when its stock price falls below its long-term average valuation, locking in a margin of safety. This is a core holding in a conservative wealth management strategy. Growth. Think of a company like Nvidia in its ascendancy. It was and is a company at the epicenter of a technological revolution. A growth investor was willing to pay a very high PE ratio because they believed its earnings would grow so explosively that the valuation would eventually be justified. This is the high-octane, aggressive part of an investment portfolio. Both philosophies have a dark side, a trap that unwary investors fall into: the value trap. This is the greatest risk for a value investor. A stock is often cheap for a very good reason. They buy a company with a low PE ratio, believing it's a bargain, only to discover that its business is in a state of terminal decline. The stock is a melting ice cube, and its price never recovers. It was a trap, not a bargain. The growth trap. This is the fatal flaw for a growth investor. They become so captivated by a company's story and potential that they conclude that any price is justified. They pay an astronomical valuation. If that spectacular growth slows even slightly, the stock can collapse 80% or more, as many learned in the tech sell-off of 2022. Avoiding these traps is essential. But the greatest investors of our time argue that the entire value versus growth debate is a false choice. They use a more integrated, powerful framework. The advanced strategy, the unified theory of investing. The late, great Charlie Munger said, "All intelligent investing is value investing." Warren Buffett, who started as a pure disciple of Graham's value, evolved his thinking, famously stating, "Growth and value are joined at the hip." This is the unified theory. The sterile academic definitions of value and growth are flawed. The intrinsic value of any business is the sum of all its future cash flows, discounted back to the present. Growth is simply a variable in the value equation. A company with high future growth is intrinsically more valuable than a company with low future growth, all else being equal. A company with no growth has value. A company with high growth has more value. The job of the intelligent investor is not to choose a style. It is to perform two tasks: to calculate a reasonable range for a company's intrinsic value, which must include an honest assessment of its future growth prospects; to buy that business only when its market price offers a significant discount to that calculated value, a margin of safety. This dissolves the dichotomy. A tech company with explosive growth can be a value investment if its price is less than its intrinsic value. A boring industrial company can be a growth investment if it is purchased at the beginning of a new growth cycle. The real debate is not value versus growth. The real debate is, and has always been, price versus value. Let's distill this great debate into its three essential conclusions. They are opposing philosophies. Value investing is the art of buying a dollar for 50 cents today. Growth investing is the art of buying what you believe will be worth $10 tomorrow, for $1 today. Performance is cyclical. The prevailing economic environment, particularly interest rates and GDP growth, is the primary driver of which style is outperforming at any given time. The masters unify them. The most sophisticated investors understand that the debate is a false one. Growth is a component of calculating value. The true art of investing is to assess the intrinsic worth of a business, including its growth potential, and then to buy it for a price that is substantially lower. Don't be a value investor or a growth investor. Be an intelligent investor. Be a business analyst. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.